Welcome back to the channel. My name is Brad, and today we're going to talk about the Great Meltdown. Everything is going to zero. Or is it the Great Melt Up? Or is it a bear market? Let's talk about this. I've been trying to say this for weeks. I've been kind of holding off. I've been kind of holding back my tongue. I've been telling you guys, if you've been watching the Sweet Teas, that long-term inflation bets or it's going higher, and there's no doubt about it. I don't know why people are just sitting there. The world is falling. So got an email say, tell us what to do in a bear market. So if you're here to talk about the bear market, stop the video, give me a thumbs down, and go watch something else. If you're here to figure out what you should be investing in, and especially if you're 20-something, I'm going to give you some picks. I'm literally going to hold your hand and tell you what you need to be buying, because there's no question where the market's going. Now, if you're an income investor, I'm going to tell you where that is also. That's different. If you're 20, 30, I'm going to show you 4 picks right now, not on the 1-year chart, not the 3-year chart, but the 5-year chart, that you're sitting there scratching your head, wondering why you're like still sitting around in your underwear, living in your mom's basement. Because these things, this is where it's going. If you don't believe me, I don't care. This is where it's going. So let's talk about it. The national debt. I don't care who the president is. It doesn't matter. They're inheriting a debt that's unsustainable, without a doubt. How did we come up with this debt? We spend too much money. Who owns the debt? The public does. Slides don't lie. This is right from the federal government. Links below. We're sitting at $35 trillion. And it's 123% of GDP. GDP is important. If you don't understand this, I'm going to explain it to you so you get it through this noggin that GDP is important. Why, Brad? Why are you saying this? You're scaring me. But I'm going to tell you where to invest. Not financial advice, not legal advice, or accounting advice. Just Brad talking on the internet. And it's free, kind of, because you had to watch a commercial to get this far, but it's free advice, so it's worth what you paid for it. Hey, so let's talk about this. Right now, the interest rate that we're paying is 3.32 on that $35 trillion. Okay, they're lowering interest rates. I've said this in tons of videos. They're going to have to lower interest rates because they can't afford to finance the national debt. They just can't. So let's talk about Hauser's Law. Okay, everybody start Googling, oh gosh, where's Brad going? It doesn't matter what the tax rate is. What? You can see back in the 50s, they tried the 90% tax rate. You can see that in the 70s, they tried to do that 70% tax rate. You can see that they did it back in the 90s. They tried that 40% tax rate. Well, let's see here. Federal tax receipts as a percentage of GDP. All those years, we're only averaging about 19.5%, no matter how high or how low we raise or lower the taxes. Wow. And if this is news to you, then I don't know what to say. If this is news to you, and you're listening to everybody talk about it, this should not be news to you. You're not paying attention. This is old news. This was news 10 years ago. But nobody talks about it because it's hidden. You got to put this aside. It doesn't matter, right? You know, even if we tax the richest people in America at 90%, all it's going to do is drive down GDP. And guess what? We're right back to that 19.5%. So that's where the problem lies, ladies and gentlemen. How do we increase GDP? Not increase taxes, because you can lower taxes and GDP is going to go up. It's always a percentage. But what major factors in today's economy is going to move the needle for GDP? Well, it's been around. You're not paying attention. And a couple more charts here. Let's talk about percentage of GDP ratio. We're at 23% for the financial year 2024. But guess what, ladies and gentlemen? That's overspending. We only take in 19.5. There's your debt. Now, you got somebody that's going to try to do some other tariffs and raise. It's not going to work. You have to raise GDP. So, again, Congress budget. If you haven't looked at this, go ahead and take a look at it. It goes up and to the right, ladies and gentlemen, up and to the right. Just like the stock exchange is going to go up and to the right because we have no other choice but hyperinflation. Any other comments? Leave them below. This is where we're headed. 2024 budget, we're paying $892 billion in interest payments. And the forecast, 10 years from now, is $1.7 trillion for interest alone. Interest. Okay, so if you're a margin trader and you're trading on margin, this would be killing your account. And you can understand if you're trading margin that the lower the interest rate on your margin account, the better, more profitable you can be. So the federal government is doing just like your margin account, lowering the interest rates because they can, so they can refinance that margin at a lower rate. Hopefully that kind of sinks in to where I'm headed with this. So where's it going? How can we adjust GDP and make it go up? What technology today can adjust for GDP? How can we get higher GDP so we can earn more money, so we can not pay down the national debt, because that's never going to happen. But we're going to be able to maintain some level of hyperinflation in the future. AI, ladies and gentlemen. AI. If you don't believe in AI, just forget about it. Go put all your money under the bed, because you're going to just always think that there's a bear market coming in. You're never going to make any money. Ever. You're going to get out at the wrong time. You're going to get in at the wrong. I don't know what you're going to do. You're just going to do something and waste your time and waste your money. But AI is the wave of the future. There's no question about it. And let's talk about that. If I'm in my 20s and my 30s and I look at the 1-year chart, well, IGM, something called Time, AMOM, and IETC all just whoop up. Just take a whooping to the S&P 500. Somebody posted last night, you can't look at a 1-year chart and make reasonable decisions. Okay, Mr. Pessimistic, let's take a look at this. If I go to the 3-year chart, S&P 500 took a whooping again. Wow, that S&P 500 likes to take a whooping. Now, AMOM, a little bit behind, but okay. Still taking a whooping. Now, here's the conversation. 3 years, not enough. Let's look at a 5-year chart. 5 years. 5 years, ladies and gentlemen. Oh, wait a second. S&P 500 taking that whooping again. Just taking a wow. Wow, ladies and gentlemen. You can't even be looking at this going, why am I invested in the S&P 500? Because it's taking a whooping on the 5-year chart. Not my chart. You can get this on Seeking Alpha. But clearly, on a 5-year chart, AI is killing the S&P 500. And AI is going to kill the S&P 500 for the next 5 to 10 years. Because that's the only way we're going to get GDP up, is through AI invention. Goldman Sachs says it. I'm saying it. If you're not paying attention, just put your money under your mattress and watch it go away with hyperinflation. So that last one, we're going to throw this out one last time for you. 195% on a 5-year chart. IETC, 179% on a 5-year chart. IGM, 167% on a 5-year chart. AMOM, 127% on a 5-year chart. And the poor little S&P 500 that everybody likes is 88%. Ladies and gentlemen, if you're not investing in AI and AI type companies, you are going to get left behind. Now, for income investors, this is why I have a percentage of my portfolio in something called FEPI and AIPI. Because right now, they're the only thing really out there besides some of the other funds like QQQI and anything invest in, the NASDAQ has to offer in AI. Always looking for that next one, but let's face it, this is where the next 5 to 10 years, this is where the growth of GDP is going to come from. And they're going to lower interest rates, they're going to spend more money. And if you looked at that one chart, and I'm going to bring that one chart right back up again for you. This one chart says it all. That is what is going to happen to the S&P 500 for the next 10 years, up and to the right. Now we'll have some dips along the way. 100% we're going to have dips. And we might have GDP get hit. But GDP is not going to get hit because we're going to print our way out of it. 2008, they started printing money, and it's not going to change anytime soon. Anytime something goes bad, it's going to be a 6-month hiccup, and they're going to print their way right out of it. So, income investors, stay the course. If you're my age, I can't play the market. I can't take a dip of 20%, out of my account. I don't want to. That's not why I income invest. I income invest because I can, and because I feel that I'm going to be able to take my money and live comfortably. That's it. And if I was in my 20s, I'm in AI stocks. I just gave you a 5-year chart. You could have just killed it over the last few years. AI, the next 5 years, 10 years is the way to go. Bear markets, anybody that is bear market naysayer, you're watching the wrong channel. You don't see me shorting. As they put more money into the M2, M3 money supply, look at the chart. It's going to go up and to the right. I can't tell you any more than that. You should have some AI stock. Now, FEPI and AIPI is mine. I'm waiting for others. I'm waiting for that next one to come out that I can jump in. That's going to give me a little bit of income. And lastly, I've been preaching this too long. Did you buy your Bitcoin? Because it just made a new all-time high. And just all I can do is shake my head because you didn't buy it. MicroStrategy, it's going to go through the roof. It's going to collapse back down again, but it's going to collapse right back down to where it is now. You can go back and look at the charts. It'll run up the next 6-8 months. It'll come right back down. But that's the way it plays it. And then the next run, it's going to go right back up again. Don't believe all the hype. And it can always go to zero, ladies and gentlemen. So that's Brad's rant for the day. Hopefully you like it. Hopefully you don't. Get away from the bears. Get away from the people. If you get I'll leave you with this. My dry powder is in the S&P 500. That's where my dry powder lays. If your dry powder's laying around only collecting 5%, that's all I can do is laugh. Because your dry powder is wet powder, not dry. Because you're losing money because they're printing money and you're not ever going to keep up with the rate of inflation. Just saying. Ladies and gentlemen, I hold everything besides my little 6-month security blanket. I hold everything else that's not an income in the S&P 500 and QQQM and a little bit of Berkshire Hathaway. That's where I hold my money. That's where my sideline money is sitting, because long run, it goes up and to the right. Until next time, God bless.